Okay, I think we're over time. Shall we start? I think so. I got the nod. Good afternoon, everyone. Thanks for taking the time to come and hear us today. My name is Giles. I'm one of the managers on the JSS Sustainable Equity Global Thematic Fund. And I've done exactly the same job for 17 years. So if any of you at any point have any questions or you want to talk about literally anything that we do or don't cover, we've got a long time in this session, so just feel free. And if it isn't in the slides, I'll be able to talk to it, hopefully. Flown over from London today and have offset my carbon, so I think we're relatively neutral on that. So I'll talk maybe for the first 10 minutes just about what we do and why we do it. I know that the world is on its own journey with sustainability. Everyone, no matter from the smallest private client up to the most complicated structure, is in their own journey with sustainability. We've done it at Safra Sarasin for a very long time, over 30 years, which means only two things. It means, one, we have a lot of data, and two, we have a lot of people. So hopefully I can give you kind of a relatively unique perspective of how that helps us. I'll spend 10 minutes talking about what we do, why we do it, and then I'll spend, or 10, 15 minutes, then I'll spend the same on the markets right now, because I think for the first time in a very long time, we're faced with certain market conditions that I think you have to talk about when you think about equities, when you think about being sustainable, when you think about being thematic. So I'll try and give you a lot of the information that we would look at. And then from there, I'll just give you sort of some small charts on why we'd be different. But I really want to leave a bit of time for questions. I realize that sustainable has many different angles to it, but hopefully I can give you some insights into what we do and how we do it. So I'll be really quick on product, because what we ultimately do is build a 40 stock portfolio. So you're taking quite a different perspective to the benchmark. Over a long period of time, you can see that that's been very successful. This is against the normal global equity peer group. And this is what we'll kind of focus on when we talk about markets, is how much have markets changed and why? And actually, does that mean anything over a long period of time? We haven't had a pandemic in 100 years, and we haven't had a European war for a very long time. So things do change, and I'll talk a little bit about that. We'll spend a bit of time on this slide. So again, if you have any questions, let me know. But the reason that sustainable or growth or thematic equities have been so good for so long is actually pretty simple. It seems complicated, but ever since 2007, the Chinese workforce stopped growing. So everyone sort of thinks that the global financial crisis on its own created this environment of low interest rates and low growth. But the truth was, the peak of Chinese sort of baby making happened, and 20 years later, there's no more labor, and Chinese wages went up a lot because of that. And so basically, the world stopped having this free growth engine, if you like, of cheap Chinese imports. And that was 2007. Second thing that happened in 2007 was technology went from being sort of semi-disruptive after the tech bubble that we had in the early 2000s, and this is when cloud computing first came in. And this massively changed the whole landscape of technology. It basically meant that anybody in this room could start a company for virtually no money and rent the infrastructure. So that's cloud computing. The third thing is climate change. For the first time, climate change became a financial weapon. And you'll know that because it used to be called global warming right before then, and they changed it into the governments of the world changed it into a financial weapon. And the UK came out with its report in 2007, and we all launched funds, right? I ran two of the first ever climate change funds that were launched in the market. So climate change became a very real investable theme, and then you saw all of the growth of clean tech, etc. So 2007 wasn't, the reason these things have worked isn't because of the GFC on its own. The GFC put a load of debt in the system, which suppressed growth. But when you add in the fact that China couldn't grow the way it was anymore, it couldn't export its goods for free anymore, the world had to care about carbon emissions for the first time, and technology was just being destroyed and disrupted at a pace you couldn't understand. The world just changed, and ever since 2007, being sustainable or being growth in its various ways, just constantly outperformed. Now, obviously, within that time frame, certain things change that, but I thought today it'd be fun to say sort of, why are people now so worried that the world is going to grow at very high rates again? I think most of us are very suspicious about that, but it has had an impact, and we'll talk about that. And I'll just talk about these 5 major themes that we think work now, they work in 5 years, they work in 10 years. So this digitalization argument, just to take the top theme, when you think about cloud computing, it started in 2007, like we've talked about. If you look at Microsoft reporting last night, their cloud business, which is the second biggest, is growing 42%. So I'd love to know how that growth rate isn't a very real and structural change in the way that people constitute their IT infrastructure. It's going to grow. It's maybe 30% penetrated at the high end, but it will grow and grow from here. It will go global. It will go to every infrastructure you can think. So again, we're not obsessed by being overweight software or overweight things that are expensive, but you can see that for us, no matter what you talk about in digitalization, it's going to grow and grow, and the challenge is actually to find things that are actually the wrong price. It's not to back the theme. When you think about automation, so we know over the long term that, population growth has peaked and you're going to get declining and aging populations. But I guess what has surprised a lot of people in COVID is that there's no labor anymore. And it's really interesting because it touches a few other things, but for the first time in 10 years, if you're an American, you're willing to change your job. You have the confidence to move state. This hasn't happened since the GFC. And that's basically because in COVID, Amazon grew 60% and they hired everybody that worked in a bar or a restaurant or a shop, and they paid them more. And now as the bars and the restaurants and the shops open, who are you going to hire? There's no one left. And people over the age of 50 have retired. They're very, very wealthy. Of any major economy, the Americans have more equity than any other cohort. And so, of course, they've made huge money. Even a fund like this is up 100% in 5 years. So imagine that extrapolated against the wealth that exists in North America. And guess what? They've all retired. So today, for the first time in 20 plus years, you get 6% wage growth. And that just hasn't happened. And so why is that happening? It's really interesting. Well, I'll tell you what will happen is that eventually prices go up too much and people buy robots. So again, we can all be sort of short-term negative, but in the long run, automation has had the biggest sort of boost that's hidden right now because people are worried about the macroeconomy than it could ever have. And so whether it's, for the first time now, fruit separation will happen with robots because it's affordable, because you can't find the labor. So don't think that labor availability is going to come back. That when you backtest or you empirically look at how many people come back to the labor pool once they've retired, it's very low. So again, these are structural shifts you have to kind of think are very real. Not everyone is going to go back to work. In terms of the consumer, it's probably our most challenged theme on a multi-decadal view. We all consume way too much. In this room, probably 8 times what you should consume. And, all of the other countries are getting wealthier, are going to try and match your lifestyles, right? I'm not generalizing too much, but... and what's going to happen is, what happened since COVID, interestingly, is equality just stepped up a gear. So the minimum amount of females and minorities on boards just went up a level. It didn't go down a level in COVID. People stopped having children, which we'll get to in the aging section. And all of the transfer of wealth that will happen in Asia, you're going to grow, 300 million Asian wealthy consumers, and that wealth transfer is very biased towards females. And so, it's not always good on stage to talk about men versus women, but it's very clear to us that there's a very clear transition, and we would look at that as a positive investment theme that's frankly very sustainable. Climate change. Now, we all know that this is here. We all know that carbon pricing is going to go higher and higher, but we're in the second crisis right now. So clean energy, went through a massive boom and bust cycle. 2006 to 2012 was a huge boom and bust cycle. Some of it fell down because European governments backtracked on the incentive schemes they'd put in, and we all kind of know that. Some of it fell down because Chinese said it was a strategic industry, and they invested every dollar they had in creating these monster clean energy companies, which basically wiped out Western versions of the same thing. And then what happened is shale oil brought down US gas prices to $3. The equivalent of that in Europe was going to be 7 or 8. And so the money wasn't there. It didn't justify itself. And so we're in the second crisis right now. And I think that no one likes what's happening in Ukraine. I'd say that's fairly obvious. It's a humanitarian crisis. But the impact to the European energy system is incredible. You have $4 billion a day that Germany is having to convert into rubles to pay for its gas. It's 40+% of the German electricity grid. Germany already has the most expensive electricity in Europe because of how much they've invested in clean energy. You probably all know that France has issues with its nuclear reactors just at the worst possible time in history. And so they've had to curtail production. And so we're in a situation, what I would call the second crisis. And it's interesting because the first thing you can say is, okay, let's go and buy wind turbines and wind energy and all these things. And that isn't what's happening. These guys are not able to produce because of rampant inflation at the prices that they previously agreed to. So even if we wanted to right now, we couldn't put that money to work because we know that in the short term, we need to go through this second crisis. And we need the government support to be solid and come. And the history here isn't too good. As much as I want to believe that the European Union will fund these things, you really have to take that with a pinch of salt. The history isn't good. So climate change is going to go through its revaluation. It got very expensive with tech, and it will go through a different phase. But, in the long run, that's going to be the most solid theme that you could possibly invest in. And lastly, aging. I found it amazing that people had less children in COVID and not more. I thought, maybe because I had a baby, in work from home, maybe developed markets would actually increase the birth rate. But actually, people got very worried about the economy. They got very worried about affordability, as you would imagine. And the birth rates in China are lower than they were in 1949, as in they are low, 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 which means that in 20 years' time, we've just got an even bigger problem. So the statistic I always give is, there are 8 workers for every 1 retired person now. There's going to be 4 workers for every retired person. And just extrapolate that to the impact around the world, how we're going to retire, how old we are going to be when we retire, and obviously taking care of all these people that are retired. So the world has changed. I think, just to be very clear, I haven't changed this slide because I don't think it would be fair. This is the same slide deck I've used the whole time. We do think that China or America, if you look at the politics level, are the main quote-unquote politique leaders in the world. That hasn't changed, not really. Obviously, Russia complicates that. If China were to obviously side with Russia, we'd have a very significant new risk problem in the world. But quantitative tightening went to quantitative easing, and this explains why some of these funds did so well. Now, we're in a new era. We're going to have to accept that in the short run, there will be more quantitative tightening in all of its forms. So there's not one definition of quantitative tightening. But if you think about interest rates, we already know that US interest rates will go from 50, 75 basis points well into the mid ones, right? That's quantitative tightening. We know that there'll be less bond purchasing. So quantitative tightening is a new era. And you need a strategy for that if you're going to invest in equities. Onshoring has just tripled. So when you think about semiconductors, they're all made in Taiwan, China, and Korea. What you're going to hear from now on is they're made in Japan, Europe, and the US. And that's brand new. That's not what the game plan was from 2007 to 2022. That's all because of COVID. It's all because of supply chains. And the politics is just in the background. That's not exactly why this has happened. And then lastly, we're in an inflation era, very clearly going to a deflation era. And I'll talk about this in more detail. And guess what? Most people think we're in a slightly inflationary period. And this is why today you get such a great opportunity to take a view. For such a long time, there wasn't an arbitrage. There wasn't a reason to take a very strong view on sustainability or on being thematic or equities broadly. But now there is, because you've been challenged. We have basically rewritten the book. And what I show here is, when you think about long-term growth rates, sure, they used to be very high. We all know that. China joined the WTO. They were all up in the sevens, fine. We've been so used to growth being bad that the equities and other asset prices, frankly, have all crowded into very similar things. And what we've seen in the last particularly in the last 9 months, but definitely since the vaccine, is it's unwound. And I'll show you this very clearly in equities. But what's happened is that everyone said, wow, I've got to hedge this. The last time I saw this many people buying, resources funds and all this stuff was in 2007. Right? It was because China had such a big demand impact. People thought about asset allocation. They said, well, hang on, why isn't resources and copper and iron ore a strategic asset allocation? So it's back, and it's back in size. My question is, and it's one that none of us probably have the answer to, is actually, are we at the top of that? It's a really difficult question to answer. But when every major commodity is above its cost curve, you are taking a bet on Chinese growth. There's no other outcome to that. And what I mean by that is Chinese house prices, for the first time in a long time, are down. They're not up. And that's the major source of Chinese wealth. Chinese GDP may be as low as 4%. That would be the lowest number you've seen. That's like hard landing type low, like 2015, 2016. So we've got to have a view on this. We've got to take our choices. What I would argue is it doesn't really matter. Like if you look 5 and 10 years, inflation will always kill consumer real income. If you think about Europe, wage growth is 2%, 2.9%. Prices at the supermarket are up 9%. There's not a lot of ways of explaining how that's a positive because it's a negative. The only country right now, because their borders are closed, because they're retiring, and because e-commerce grew so significantly, is the US. It's the only country that has real wage growth. Immediately north of America, in a commodities boom, is Canada. Why is their wage growth 2% if this is this massive inflation bull cycle? It's interesting. And all we show here is on the right-hand side, unless you genuinely believe nominal growth is 7%, then what happens is a lot of countries fall behind. Sorry, countries. Well, true of countries. A lot of companies fall behind. And you'll find that in the olden days, the average company was fine. In the new days, a lot of companies have a growth problem. There just isn't enough fixed asset investment. There isn't enough things to do, either by regulation, climate change, the amount of debt in the system, all demographics, all these reasons why the bigger proportion of companies now are going backwards than ever before. And that's a big problem when you invest. So this is the classic, okay, I'm going to invest in only anything that grows above nominal GDP. And it's easy, right? Let's just invest in electric vehicles, the big line. And yet you can't, because the only company that truly will benefit over any reasonable time frame not only is sort of grotesquely overpriced, it has no governance, zero. And everyone challenges you on that. A sustainable investor, when I first joined the industry, we were celebrating the 25-year anniversary of the funds. And the first thing you learn, more than anything, is governance is a no. There's no, we'll let someone off because they're, a crazy South African. You basically are not allowed to do that. It is a zero-sum game. And the fact that he buys, Twitter on a whim is, we were in the IPO. So I have to tell you, we were in it for the right reason, and we were out of it for the right reason. But if you look at what we've avoided in terms of equity return, it would be monumental. So again, this isn't me being bitter, it's me telling you, if you look around the world, EV penetration, it's still like 2%. If it gets to 30%, 40%, it's kind of not the point. The point is everyone in that supply chain and everyone who's impacted by the way that EVs are designed, they are going to structurally grow faster. The challenge is to find the company, to find the vehicle, as it were. But there's a lot of other things that grow, like cloud computing. Chinese electric vehicle companies, 500, Global cloud computing companies, 4. There's a very different barrier to entry. There's a very different reality to investing. And so we own all 4 of them with that visibility. And then I'll give you one that we talked about in terms of surgery. We know that as emerging markets get richer, they will buy Western medical technology. It's a very clear growth algorithm. Now imagine, if you will, for the last 2 years, medical device companies that were growing 30% were growing 9% because the hospitals were full of COVID. They were either full of COVID or you had to reserve them for COVID. And what's happened, particularly now, which is hopefully me telling you that the strongest theme I believe in right now is medical technology and elements of drugs that weren't COVID effective. They are cheap. They will protect you from stagflation. And so it just gives you one example of one of these themes where you can say, okay, digitalization must be tricky right now. Automation's a bit tricky. But actually, in aging and in healthcare, we're probably the biggest weight we've ever been in the history of me running money in a long time, 17 years. What's not growing is the same. And some of these things got worse in COVID. So when you think about cash payments, all these countries, you might come from Switzerland or the UK or wherever, where, contactless was already 70% penetrated. Most countries were 10, and they got forced into it. And so as you look at the results of any company that has this exposure, you'll see that suddenly they grow much faster than you can understand. And that's something that will last from COVID. People do not go back to cash. It's just not something that happens. And it's the same for software. People think software is a growth industry, but it's not. Bits of software are, but a lot of it isn't. A lot of it's on-premise. A lot of it is made very complicated with cloud and work from home. So I'll give you a prize if you can tell me what the average American gained weight in COVID. This is a relevant point. In kilos. You can't tell me because you're cheating. No one's going to guess because it's always the same. But anyway, it's 7 kilos, 7.5 kilos. Now, that's a lot. Martin only put on 3 kilos, so he feels like he hasn't performed to his he's not his best self. What is my point?
Any advice to get him to lose it?
Soup for dinner. And it's also very climate change friendly. So what do I mean by that? Work from home. You'll all know this because you're all professionals. Whether you think you're going to be doing 60% in the office to 80% in the office is an interesting question. Today in California, it's 20. London is 50 to 60, depending on if the sun's out, which it never is. And the highest you'll find is Texas, okay? Texas, right? Because they're big, strong, and COVID doesn't exist. And they're at 65. So whether anyone likes to believe it or not, I'm not picking on Americans. They have a lot of data, so it makes it easier. And what you'll find is that work from home, and if we had to put a new category on here, we probably would put offices, right? We'd probably have to put offices now. Not because of rent rises and in prime cities. I don't even know much about offices. But what I will tell you is, how many people here, honestly, are in the office 100% now, apart from Bank J. Safra Sarasin? I'm serious. And it's become a way to hire people, right? I want to appeal to the Gen Zs. I want to appeal to millennials. In fact, in our office, I'll tell you, it's the older ones that are loving their kind of, I get to read more in my own time. I get to, be less, sort of less around some colleagues, whatever it's going to be. But this behavior is very sticky. And and that's why we would be really thinking on the next 10 and 20 years, offices for us are just not going to be as compelling. The one thing that, again, I've said that hospital surgeries we think are going to really come out of this strong. The second one, if you want to be short term, is traveling. Traveling is, the statistics on it are amazing. And people get this wrong for the wrong reason. Because they look at how many flights. So if you look at how many flights, the flight level's below, but look at how much the flight cost. And you're already above 2019. And if you just don't believe me, look at a company like Marriott, okay? They're earning more now than they were earning in 2019. And so this is the recovery that you're definitely seeing. Barbecues went up 90% from 2019, 90%. Okay, now who wants to bet that they just have 10 years of doing nothing, right? As people just figure out that they've got better things to spend their money on. The average American, which might explain their weight gain, the average American got $3,000. That's insane. No one gives a family a $12,000 gift when COVID was really a 2-week problem. When you think about how much do I have to stop everything for, everyone got $12,000. So I can tell you, if you look at the price of second-hand Rolexes, you'll see exactly what you need to see. There's a lot of COVID fraud. There's a lot of government support that immediately got spent. And so just as another analogy, what could be negative here? Maybe in-home spending. Maybe people have spent so much money on their homes that for 5 years we're going to have to be extremely careful. In terms of the market backdrop, I don't want to spend too long on this, but it may interest people who either are existing investors or think about style and factor risk and everything else. What do I mean by that? Everybody is underperforming all at once. And that's because it's quite interesting. This just shows you active fund managers, right? So the old active versus passive debate. It only ever happens really to this degree when interest rates rocket, because everyone in equities is basically duration. And this is what sustainability gives you, unless you manage this risk. It puts you into duration, and being growth obviously puts you into duration. And what I mean by that is, if it's not clear, so much of the cash flow comes so far away from the T5, or from the initial investment period, that the way I would discount all of that is so sensitive to the initial value. Now, I know we're all in finance, probably that's obvious, but was it obvious with this level of crowding? This level of crowding creates what we've seen for the last 9 months, which is absolutely phenomenal companies 50% below where they were, 50. And that's something you've got to think through. At one point, 50% is too far. I only show this very quickly to say that many people don't have a balanced approach to sustainable thematic investing. It's very, very easy to build a fund where you pick the best winners for the next 20 years and you just go to sleep. What I try and show you here is if you do that, and this is the last 5 years, this is 200 funds we would look at that do a very similar thing that we do. There are that many. And we're 10th, okay, on the return, 86% after fees, and you think, okay, now why are we 10th? And I'm going to layer in some points here because everything I've said so far is probably a bit negative. Look at the way that the growth peer group are. So anyone who's a bit in growth, and just look at the year to date. This is the biggest drawdown you'll ever see, 17, 18%, right, in a very short period of time. Look at where we are, and I'll try and explain why. Because when you do sustainability for as long as we have, you have to look at sustainability with risk and reward. It's never just one thing. You are taking a view, you are different, and it doesn't always work. And this shows you that, these growth managers, you'll read about it. I'm not allowed to technically mention any names, but, there are people that you'll see all the time, and they raised a lot of money, and you've now made more money shorting them than you have being long them. And why? There's no balance. There's no way, and this is the average growth fund over 5 years is down 2% relative to its index, the average one. The best one you can find is 1% ahead. So look at how much money got crowded into a tiny space. COVID poured petrol on it. Everything went crazy. And we were sat there thinking, wow, we've got to rotate this money as fast as possible because there's zero valuation arbitrage. What do I mean by that? It's probably hard to see from there, but I'll explain it. The big black line says, if I just took the top 10 most expensive companies of an index and I compared it to the average, how big is the gap between the two? And you can see that you'd have to go back till 1928 to find the same deviation. All right, so this is, I can't even remember the name of it, Wall Street crash, right? October crash, there was a good reason for it. Total lack of confidence. You saw it in the GFC, but if you took out the banks, it wouldn't be anywhere near that distributed. So we're now above GFC and dispersion of the difference. Now I can tell you, yesterday it was neutral. So this is the problem we've been in ever since the vaccine, ever since September 2020. Being sustainable, being global, it was great, but you took too much return too quickly and you had to rotate your capital out. And I'll tell you, I've never in my entire career ever seen a long-term sustainable thematic fund. We sold 25 names since COVID, which is almost unheard of. And thank God we've got 13 analysts, because imagine doing that in a 2-man team or a 3-man team. It would be, frankly speaking, impossible and very risky. So the world as we see it today, actually neutral growth value. We haven't been able to say that for a very long time. Now it's neutral. I won't explain it because it's tough to see, but if you look at the black dots, that's where it's neutral. Okay, so we can show you regionally, where is it neutral, where isn't it? Now interesting, isn't it, when you see Europe, the only region where you haven't had value outperform to neutralize the valuation dispersion. And you've got to think why. And it's all about the war. It's about the war, it's about wages. So when a lot of these European countries get these energy bills through in September and their wages haven't gone up, there's going to be a very significant delta to that. And so I think Europe, unfortunately, even though it might look cheap, has this overlaying risk that makes it very, very difficult to invest in right now, because all of the great companies of Europe in terms of big, sustainable global future actually look really expensive. And so if there was a ceasefire, you would see the biggest factor shock in Europe of any region. Why is it interesting? Well, Canada, which is obviously very resource heavy, but now actually expensive for value, which hasn't happened in a long time. And then things like the UK, which is a terrible stock market. It's not the greatest country, but you can see that even that's fallen right the way down. It's much cleaner value growth divide in the UK than there is in Europe. Why? These are all interesting kind of things to us. But really, I'm only talking about this because of the state of the market right now. And what you can see is GFC, Euro crisis, China hard landing, and now. And you see these huge moves in the discount rate. So this is the real question, is at some point, valuations will reflect these higher discount rates, and people will go back to saying, if I can buy a company that's growing 25% and I'm paying 16 times, there's very few ways you can lose. And so I'm not going to say it's now, because no one can tell you that, but just be aware that on a ceasefire or on any change in the underlying macro politique, there are some extremes. And these are extremes that we've always avoided. And actually, frankly speaking, at the moment, we would take advantage. Now, what is working is virtually nothing. But now imagine you're a sustainable thematic investor and you have to try and invest in energy, insurance, materials, telecommunications, utilities, or supermarkets, or tobacco. Right? It just doesn't happen. And at the bottom, you've seen all of the stuff that we would generally speaking say has a great future: semiconductors, software, elements of media and entertainment, healthcare equipment and services. These are the things that actually long-term are going to grow. So, like I said, no one can give you the answer, but this is either a phenomenal opportunity to think about where you want to be positioned, or it's at least a neutral, and we haven't been able to say that for quite a while. Why does it not matter? Ultimately, this is the point. I mean, this is what I'd like to get into. It's maybe not as interesting for everyone, but when you build 40 stocks and you're a stock picker, you should be able to get through any market environment, right, over a reasonable time frame. And what you can see with the white line is just one of the funds that we run. You can see that the white line we're actually doing okay, as in actually stock picking wise, uncorrelated returns fine. But the green line, look at COVID, right? Let's be growth, let's be sustainable. Okay, hang on, let's not. And you can see this complete reversal in factor. So I like looking at risk models. They're not all great, they're not all perfectly accurate, but when you think about outperformance of certain funds, just mirror them to that. That's all they are. And so all my kind of message would be, sorry, I don't know exactly where we're on time. It should be fine. Sorry, all where my messaging would be is I try to back things that I know are going to happen. I know in 5-10 years they're going to happen. What is even more important is to not overpay. But when you look at the various different themes, a multi-thematic fund allows you to go where the opportunity is. So right now we're significantly increasing our aging portfolio, and we're very, very, very closely monitoring climate change. because of the idea that Russia's gas supplies might be permanently impaired. Now, if that happens, you will see opportunity there. Right now, might not be the best time, but that's where we're actively monitoring. And some of these guys are going to have their COVID hangover. This is true as a theme. And so I'm just trying to give you maybe a little bit of where we're thinking, definitely healthcare or aging, definitely energy grids, energy transition, but you have to be very careful what you pay for it. And this is ultimately why, if we differentiate in performance at all, it's because we are never 100% committed to high quality growth, sustainable, unless the valuation's there. And as I've just mentioned, for the first time, maybe we shouldn't be so contrarian. Maybe we shouldn't be so much in the special situations. Maybe a lot of those have played out. And so we're starting to think now about rotating the other way, which can sound like we're just contrarian for the sake of it, but we can see valuations here in software security that are extremely compelling. That has not been true since 2016. So this is the first time in 5-6 years that we can start making those statements. And I guess I do want to leave a little bit of time for questions, sorry, because I talk too much. But on the left-hand side, we want to be ultra low carbon. So we want to be as far away from carbon risk and pricing as possible, which is a structural view of the fund. We are committed to be carbon neutral by 2035. But on the left-hand side, we show you that we are going to grow faster than average, we are more profitable than average, and we have a cleaner balance sheet than average. So even though we try and neutralize style risk, and today we're 50% quality growth, we're 25 contrarian, 25 special sits, you can see that that's a very deliberate reason because of the inherent positioning. So maybe I'll just stop there and leave it on here, but this is a very interesting point in history. There are some very difficult questions, but hopefully that gives you kind of a landscape of what we look at.